The one big beautiful bill has officially passed into law. And today we are going to break down our top 5 tax changes to be aware of and the financial planning considerations you may want to consider with those. Welcome to Couple Bowl. My name is Michael Dunham, and with me today is Patrick Fontana, the founder of Fontana Financial Planning.
Welcome to Couple Bowl, Michael. Cheers.
Cheers.
So I will hit number 1. Importantly, kind of covers everybody. The current tax rates were extended, and they were set to expire or sunset after this year. And we've been talking to folks all year about this kind of pending possibility of rates going back to worse rates. Now they're extended, which is good news. I think in general, most folks will be affected by that by paying less in taxes. The current rates are locked in.
And they are locked in permanently, which in tax speak means they are locked in until the next tax bill passes. So foreseeable future, the current rates that we have right now will be indexed with inflation, but we'll not see any changes to our tax rates. So number 2, and kind of impacting the tax rates is the impact to standard deductions and itemized deductions. And so this is actually effective 2025 this year. At the start of the year, the standard deduction for a married couple was $30,000. That has been increased to $31,500. And for single filers, half that, $15,750. And so if you're unaware of what the standard deduction is, it's the deduction in income that everybody gets to take. So regardless of whether you itemize, regardless of the rest of your tax situation, you get to reduce your taxable income by $31,500 as a married couple, $15,750 if you are single. Additionally, there's been a lot of headlines around the so-called no taxes on Social Security. So to kind of break down what that actually means in practice, seniors, anybody age 65 or older, regardless of whether you've claimed Social Security, gets an extra $6,000 per person deduction on top of their standard deduction. So married couple filing jointly, both spouses are over the age of 65, your standard deduction goes from $31,500 to $43,500. That is phased out if your income is over $250,000 as a married couple or $150,000 as a single filer. So let's talk about a couple financial planning considerations with that, because I think that there's a lot to know about the standard deduction for individuals as well as the standard deduction for seniors. And so with that phase out, if you are one of those seniors that's of required minimum distribution age, which is age 73 presently, down the road it'll be pushed up to 75, but 73 or older, you are required to take a minimum amount out of your retirement accounts every year. And it's not uncommon for those individuals that number can be substantial. And so with that phase out, that is something to be aware of, where a required minimum distribution could theoretically push you above that limit and eliminate that tax deduction. Also, Roth conversions, which is a popular strategy that we like to look at for individuals who have stopped working and seen a drop in their income. You could potentially do a Roth conversion that pushes you over that $250,000 or $150,000 limit, depending on your filing status, and potentially cost yourself this $6,000 per person deduction in the process.
So to jump onto one of these other bullet points on that, the charitable deduction for, say, my folks, if I understand this right, they get a married filing jointly 31.5 number plus the senior 6,000. So does that mean the hurdle for them to benefit from, say, a charitable contribution, if their house is paid for and they have, not much other things that they would actually itemize, that number is pretty big, 31.5 plus 6, they've got a huge hurdle to get over before they would benefit from, say, giving $10,000 of stock to a company to a charity.
Yeah. And because they're married, $31,500 times or plus 12. So 43,500.
So big
when
number
you're,
for
when
for the
you're married.
seniors. That 6,000 can really affect things when it comes to whether to itemize or not.
Right. Which makes the qualified charitable distributions that much more beneficial for those who are of the age to be able to take them, which is 70 and a half. And so a qualified charitable distribution allows you to give money to charity. It comes out of your IRA tax free. And when you're of required minimum distribution age, it also counts towards your required distribution, even though it doesn't get included in your taxable income. Now, I will say one of the changes in the tax law that would be applicable in this situation is starting next year, non-itemizers can give $2,000 to charity and take a deduction, even though they're not itemizing their taxes. And so that's one thing for people to be aware of is a lot of people in today's day and age are not giving enough to charity or having enough itemized deductions to get a benefit. Starting next year, you can take the standard deduction, but also write off $2,000 of charitable contributions.
Got it.
One other item that I will add in on the topic of itemized deductions is what's called the SALT cap, or the state and local tax, which has been capped since 2017 at $10,000. And so this is applicable really to people in high property tax states, high income tax states. So here in Texas, we have high property taxes where somebody may pay $20,000 or $30,000 in property taxes if they have a nice expensive house, and they are capped out at being able to deduct only $10,000 of that. In California, New York, these high income tax states, they may be paying 20, 30, 50, 100,000 plus dollars in state taxes, and they're capped out at paying or deducting 10,000 of SALT cap. So that has been increased to $40,000 starting this year, effective through 2029. So it's a temporary window. But during that window, the SALT cap has increased to $40,000 with the caveat that there is now a phase out that phases you back down to that old $10,000 limit. It begins at $500,000 of income. Up to $600,000 of income is when you are fully phased out. And so for certain individuals, theoretically, if you had a $40,000+ SALT cap and you went from making $500,000 to $600,000, your taxable income could theoretically go up by $130,000 in that scenario. So not a ton of people will be affected by that, but for people who are in that income range and are in a high property tax or high state and local income tax state, it is something to certainly be aware of as you look for the best way to have your income structured.
Okay, tax top 5 thing number 3, estate limit. The estate limit was set to sunset at the end of this year. We've had a lot of conversations with clients that are in that range of potentially having an estate planning problem if it reverted to the old limits. It's now set at 15 million per person, so 30 million for a married couple. So that is eliminates that concern for folks that were in that range, and it's good news in the sense that you don't have to worry about it if you were in that net worth range of say $6, $7, $8 million, where we were concerned, hey, when this sunsets, then you could have a possible estate tax bill. Now that's locked in at 15 million per person. And is that starting this year?
Next year. So
next year, 2026.
This year, the limit is $13.99 million per person, or just under $28 million for a couple. And so it's increasing more likely than it would have otherwise if they had just kept with the standard in inflation indexing, but 15 million per person, and that number will get indexed up over time as well.
Number 4, take us away.
Yeah, so going to go over a couple of impacts to business owners and owners of real estate. And so the first is the qualified business income deduction. So this was introduced in 2017 as part of the Tax Cuts and Jobs Act. And what it allows is for business owners and real estate investors, a 20% deduction on qualifying income. And so that has been permanently extended. It was set to sunset after this year. That's permanently extended. And there's a higher phase out range for individuals who kind of fall in the phase out range if you are an owner of what's called a SSTB, specified service trader business. So think financial planners, orthodontists, dentists, somebody that's in a service-based business. There's a phase out, and that phase out has been expanded. So you may theoretically get a larger QBI deduction if you are in that phase out. Section 179 deductions are the ability to write off the purchase of an automobile, a plane, machinery, heavy equipment. You're able to take what's called a Section 179 deduction. The limits have increased, and I'd say more notably paired with that is what's called bonus depreciation. So bonus depreciation was introduced as part of the Tax Cuts and Jobs Act as well. And it has been getting phased down to where next year it was going to be phased out. And they've now made bonus depreciation permanent with a 100% depreciation. And so to kind of explain what that means and who's impacted by it, if you own a business and you buy an automobile that's used for business purposes, as long as it meets the qualifiers for Section 179 deduction, you could theoretically depreciate 100% of the value of that vehicle in 1 year to offset a good portion of income. If you are a real estate investor and let's say you buy a rental property and you do a cost segregation study, the qualifying portion of the real estate that is allowable in the cost segregation study, you could depreciate 100% of. So really what is worth knowing about this is for certain individuals, it will allow them to deduct a significant amount of money on these large purchases. And if planned appropriately, you can time that with higher income years to get a bigger tax deduction. And so it's definitely something to be worth being aware of and to do some planning if you may theoretically fall into one of those opportunities. And then the final business owner tax improvement that I'll bring up is what's called qualifying small business stock sale. And so I'll say this is one of the most unique provisions in the tax code. Historically, it has allowed qualifying businesses to exclude $10 million in capital gains when you sell your business. That exclusion has been increased to $15 million per person. And so it's a pretty significant exclusion. The biggest detriment to being able to take a qualifying business stock sale deduction has been the requirement that the business has to be a C Corp and fall under certain asset levels. They've now introduced a tiered structure where if the business has not been a C Corp for 5 years, which has historically been the requirement, you can get a 50% exclusion if the business has been a C Corp for 3 years, a 75% exclusion for 4 years. And the asset requirement has increased to $75 million. And so if you are a owner of, say, a tech startup business that may theoretically sell, this may be an opportunity to exclude a fairly significant gain and save a pretty substantial amount of money in taxes. Patrick, I'll pass it over to you for our last update on 529 changes.
Number 5 of the top 5 is appropriately 529 plans. So I would say in this scenario, we have continued the trend of being more flexible and having bigger limits with what you can do with 529 money. Previously, the limit for paying for private school was $10,000, and that's bumped up to $20,000. So paying for actual college, the limit's whatever the bill is. So my daughter will be starting out next month paying college, and I just paid her first tuition bill, which was unfortunately a lot. And that bill fully covered my last youngest son is a senior in high school. And previously I could take $10,000 from his 529 to help pay for private school. Now that's $20,000. They've also extended a couple of the, I'd call fringe things you can spend on to be a little more flexible. So that trend's continued, bigger number that you can take out of a 529 to pay for private school. Excellent tax update issue. Anything to add, Michael, before we do our sign off?
I will just say the biggest thing is itemizing and knowing your deductions more important than ever. It's very confusing. It's very much more convoluted than it was previously. And so if you don't have good help, now may be a beneficial time to make sure that you have somebody paying attention to all of the details for you. The other thing I'll mention is, for a lot of people, if you're watching this, likely the things that we're talking about are the things that are going to move the needle for you much more than maybe some of the headlines that you may be seeing. And so just being aware of what's actually going to impact you is another thing that I would bring up. But with that, thank you so much for watching this episode of Cup of Bull. And Patrick?
Rebalance tax efficiently. Cheers.
Cheers.